Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. On tonight's show, Julia Lee of Birmingham Invest looks at the stocks you might want to buy now to make money next year. Adam Dorr of Shaw & Partner does exactly the same thing. He goes down the same path, looking for those sorts of stocks that might do well over the next 12 months or so. And then we have Michael Gable of Fairmont Equities, who's going to look at a number of stocks that have been under pressure lately, and a couple of them been doing really well. BHP, CBA, Lynas, Lease, TYRO, Zip, and Mike's hot stock will also be thrown into the mix. This is a stock that's been over $60 in recent times. It's now around 40, but Mike likes to the shape of the charts that he's looking at right now. And then Gemma Dale of NAB Trade tells us what stocks investors are chasing right now. Watching the trend can really be your friend when it comes to investing. That's the show. Let's kick off now with Julia Lee of Birmingham Invest. Julia, thanks for joining us.
Great to be here, Pete.
So, Julia, I've asked you to look at some stocks that you think look like good buys now that may return the bigger dividends or returns in 2022. So what have you come up with?
So having a look, I guess at the moment we are seeing travel stocks coming under pressure and those companies which are exposed to Europe. So a short-term trade, we know that these lockdowns can be opportunities to buy these type of companies relatively cheaply. And when things open up, activity usually bounces back relatively quickly. So what we are seeing is Austria going back under a national lockdown. And we're also seeing additional restrictions coming through in Germany. So we are seeing some of the travel companies trading at 2-month lows. I think that's an opportunity to accumulate if you haven't already had a chance to get into those stocks. But really looking into 2022, one of the areas that I'd like to go back to, which we don't have a lot of exposure to at the moment, is the material space. So looking at the miners. We know that iron ore prices have been under pressure, but I suspect after the Beijing Winter Olympics in February that things may start to return back to normal. So looking at those iron ore miners towards the beginning of next year, so that's one of my New Year's resolutions. And look, Pete, one of the best trades for us this year has been exposure to those stocks which are going to benefit from the net zero situation. So stocks like Pilbara Minerals, the lithium miners like Orocobre, Lynas has done very well for us as well. And I believe that this is a structural shift that we are seeing. So this is something that's going to last decades. And at the moment, I think that lithium pricing is still expected to be quite strong in 2022. The time to look at jumping out of these stocks, which is just as important as jumping in, is when you get that big supply response coming through, because most commodities aren't difficult to dig out of the ground. It just takes a bit of time.
Yeah, what's interesting is that we're waiting for those vaccination issues, those virus issues to dissipate, which probably are going to take 3 to maybe even 4 months to actually happen. But when they do, economic growth should surge, should help the material stocks at least, for 6 months or so at least.
Yeah, look, I think the COVID-19 this time around is very different in that a lot of the hospitalizations are happening with the unvaccinated. So like here, where we did see a surge here in Australia and that caused vaccination rates to go through the roof, I think we'll see the same type of thing, especially in places like Austria, where the government's looking at mandating vaccinations. So it does look like a lot of those severe cases are in the unvaccinated. So as those vaccination rates go up and the booster shots come through, hopefully that will also help those COVID cases come down a lot more rapidly. Don't forget the Northern Hemisphere at the moment, it's winter, and it's thought that, it's much easier to catch the virus indoors rather than outdoors. So that colder weather is also playing a part in things as well. But look, I'd probably be avoiding things like European shopping centres at the moment, office buildings, as these lockdowns sort of make their way through the system. But hopefully going into next year, these will become less and less common as things return to normal. And we have, I guess, better ways to combat COVID-19 than when the pandemic started.
Julia, what do you think of a company like Lease? It's really struggled. It's down around near its lows. I figure in the future it's going to do well. It may well take a year or two before it happens. But do you have a view on Lease?
Yeah, look, I think this one depends on your time frame. There could still be a bit more short-term pain as it looks to try and turn around its operations. And look, one of the things that the market's really been disappointed with Lease is that it's pushed out its return on equity targets, where it's trying to get its return on equity targets higher. But at the moment, I think it's all about execution. So if it's able to do that over the next few years, I think the market will reward the stock. Of course, in the short term, we know that the construction space and the contracting space can be quite difficult. Lease, with its exposure to office buildings, it's been pretty volatile as well. But really, I think at the core of Lease is really these gateway communities that it has in large city centres. And I don't think that concept and project and strategy is dead. And I think it will be an engine of growth for it. So it depends on whether you're looking at investing over the next 6 months or the next 6 years. I suspect if you're looking at the next 6 years, then now would be the time to be accumulating here as it tries to turn around its operations. But really, you're buying that turnaround story and those goals that Lease has to 2025.
Yeah. One last question before we go. I know a lot of people are saying, well, look, there's probably going to be a bit of a sell-off because of the Austrian issues, and you've got question marks about inflation and interest rates and whatever. But what's your feeling about the stock market overall in 2022? Yeah, and I should also add this part to the question. If you were really nervous about the future of the stock market, would you go and hold a lot of cash? Would you actually liquidate a lot of your portfolio and maybe even start doing some shorting?
Sure. So I guess looking at the market, we always look at things like market volatility and whether we think volatility is going to increase, and then introduce some protection into our portfolios. And the way we do that is through buying puts or moving a greater portion of our portfolio into cash. So we don't actually go into shorting, because shorting can be quite difficult to do while the market's sort of near these record highs and still rising. So timing the exact turnaround can be quite difficult. I like to look at things in cycles, Pete. So I think we're mid-cycle, and mid-cycle generally, you can see a correction of around about up to 20%. But look, I still think we're in growth mode after that. So I think any sell down would be an opportunity to accumulate further. And look, the growth rates have been coming down a bit. If we have a look at, I guess, the growth rate in 2021, it's about 6%. That's supposed to fall to about 4.7% and 3.5% for global growth. But we're still growing. And I think that's going to be a positive in terms of the market. The other thing we're watching very closely is interest rates. I think once they start to rise, it will be okay, because generally rising interest rates is a sign that economies are doing well and growing. But I think the initial inflection from pandemic settings to rising interest rates, that's going to cause a bit of volatility as well. So look, I think there's going to be a lot more volatility in 2022, but I think that's positive for longer term investors to accumulate and just keep an eye out for those opportunities.
Love that kind of talk, Julia. Thanks for joining us.
Thanks, Pete.
Well, to look at the stocks for next year, we have Adam Dawes from Shaw and Partners. Adam, great to see you.
Yes, thank you. It's fantastic to be here, Peter.
All right, mate. So I asked you to look at the stocks that you think are good buys now, but will probably, produce results next year. And I'm kind of thinking to myself, the reason why I thought that, well, there's going to be much stronger growth next year. Eventually vaccinations and eventually concerns about more outbreaks of the virus, I presume, will become less and less of a concern, and we'll start getting really good growth. What kinds of companies are going to be, the beneficiaries of a much stronger economy and getting back to normal? So take it away. The first one you want to talk about is the material sector. Is that right?
Yeah, we can definitely talk about the materials sector, and certainly the first one is the big boy in the room, BHP. Now, everybody might think, well, that's a little bit boring, Adam. Maybe pick something that's a little bit sort of more growth orientated. But let me try and to convince you one way or another, and we've got some more growth orientated stocks going forward. But there's three things that are going to be happening with BHP coming up that is going to be very, very essential going forward. The first thing is that they're selling their oil and gas assets in the first half of next year. Now, that's going to be a massive transaction, 51% or 49% going to Woodside. That is going to be a big transaction, and I think that's going to be beneficial to BHP shareholders more than it will be for the Woodside shareholders. So that's the first thing. The second thing is that they're also in the second half of next year getting rid of the London Stock Exchange, or it's called the Unity Trade. They're going to be getting rid of their dual listed business in the UK, and it's all going to be coming back to Australia. So one, the market cap's going to rise. Two, that you're going to see BHP now, all transactions around the world are going to come through the ASX. More volume means more price activity, and that should move the thing, or move the share price going forward. And the third thing is they're talking about, and they will action now, going into potash. Potash is a massive industry. They're going to be feeding the world, and they're going to be using that. The potash goes into fertilizers, goes into making arable soil. And I think that's a major step forward for BHP, getting away from iron ore, getting away from coal, getting away from oil, and moving into potash, I think is one of the three reasons why I think BHP will be a good buy next year.
Okay, good solid argument. Let's go to the really tricky one. And I must admit, a lot of people who are warming to the idea of that something has to be done about climate change are starting to wonder whether uranium is going to be a future alternative, and you've gone for a uranium stock.
Yeah, I have, and Paladin is probably the one that, I mean, there are some other ones in the sector, but certainly Paladin is the most premium stock as well as the most liquid stock in the market. They've just come out and said they're going to restart their Heinrich. Someone's going to correct me on my pronunciation on this one, but they're going to start up their major mine going forward. Paladin remains our preferred stock in the sector, and I think that's the key thing that you need to be aware of. Always stay in the top quality businesses. Don't go for the smaller ones. Always stay in the top quality businesses. Uranium, yes, is probably going to continue to do well. We do see that, power stations, greener energy going forward, and certainly Paladin is one of those ones. Once they start up that new mine, that is going to do well as well. So yeah, Paladin, we've got to buy on that one here at Shaw and Partners.
And I suspect as a long-term play as well, Adam, there's just going to be a lot of science and research into how do we make uranium safer. It clearly is great for the environment, provided you don't have major problems and you actually can dispose of the waste. But because there hasn't been enough money thrown behind it, there hasn't been enough care or desire for it, nothing really progressed. But gee, the world's getting really on board with climate change concerns, and I wouldn't be surprised to see something come along around, safe nuclear over the next 5 to 10 years, and that would be very good for the share price for uranium miners.
Agree. Yeah, absolutely. And it's the wall of money, the green energy, the ESG money that is definitely coming down. That tsunami of money it's going to come, and you can't ignore it now. I mean, we potentially might have talked about it and laughed it off 5 years ago, but certainly now we're here. And I think, out of the 5 stocks that I'm talking today, 3 of them have that sort of ESG or green side of it.
Well, let's go to your hydrogen play, because a lot of people are interested in hydrogen. I think Twiggy Forrest from Fortescue is doing a lot to talk up the big H. So what's a good way of playing hydrogen?
Well, certainly it is an industry that's in infancy. So in other words, don't get caught up, because no one's really making any money out of this, and no analyst can really model on how to put an hydrogen plant together, let alone put a company together and see if revenue is going to come in the door. Mm-hmm. So the first thing is you need to be diversified. And that's the reason why I've chosen hydrogen. It's an ETF from ETF Securities called HGEN. HGEN is the ticker code for those people playing at home. And that has a diversification of over 30 stocks from an index that is basically all to do with hydrogen. Now, if you wanted to pick one stock, I don't think that's the right play to do that, Peter. I think you need to be diversified. I think you need to have a group of stocks that are going forward. And also there's different types of hydrogen. There's green hydrogen, which is powered by recycling or renewable energy, but then there's blue hydrogen, gray hydrogen, and there's all these different types of hydrogen out there. Now, the technology has been around for a long time, but it certainly is something that we are all starting to go forward. Even Japan, I saw in the Fin Review today, talking about getting rid of LNG, looking at hydrogen and looking to Australia to help them with that production of hydrogen going forward. So, you know, the government's putting fleets, they'll put hydrogen cars on the road. I think this is something that, you know, for next year, the year after, and the year after, I think this is a good one. Staying diversified, HGEN is the stock code, and it's an ETFS, so ETF Securities ETF.
Yeah, playing hydrogen is a bit like playing biotech. It's a bit of a gamble. And if you put 30 into one pile and 4 or 5 end up being the equivalent of an afterpay or whatever, that's when the big dividend comes for the ETF. Yeah, a reasonable approach, yeah. Let's go to the telco sector now. What do you like there? Because everyone always thinks there's only one company there, but of course there's not.
There's not. There's certainly lots out there. This one, look, it's done very, very well, and I think will continue to do well. And it's a small little stock called Aussie Broadband. You've probably seen us talk about this one before, but also you would see the advertising on television as well. And I think that's been really effective. One of the big things that Aussie Broadband has differentiated itself. Now, obviously, telco, you need to have good connections, fast speeds, internet, those kinds of things. But they've really differentiated themselves by having an Aussie-based customer service area. So, you know, sometimes when you ring these international companies, you might go to India, you might go somewhere else. Aussie Broadband is all staying Australian. And what they've done is that they've been started to become the market leaders in customer service, to that fact that Telstra has actually brought back its customer service call center back to Australia because they've had so much backlash and they're losing customers to Aussie Broadband. Now, the reason why I like Aussie Broadband is the whole idea is it's a small telco, it's nimble, it can move back and forth, it can actually do things pretty quickly, it can take market share away from these guys. They just did a large acquisition, they've raised some capital. I think this is a really, really good business. It's definitely not for the faint-hearted. It's certainly not a Telstra. It's not, you know, sort of boring. It is going to be volatile, but I think that they've got the right mix of customers, customer service, and getting the job done. ABB is the stock code we've got to buy here at Shaw and Partners. Okay,
let's go to data now. Of course, data, just like anything that's in the green area, it's the future. What do you like in that space?
Well, the one I like is Global Data Centers, GDC. Now, the reason why I like this one, yes, it does have that sort of green side of things, but where does all the data go? This podcast, anything on YouTube, anything like that, data needs to get stored somewhere, and that's what I really like, GDC. The reason why I don't go for NextDC or for Macquarie Telecom, those kinds of things, these guys are trying to do things here in Sydney and Australia where the land values are so expensive to get a data center, because basically a data center is a big warehouse where you can stack racks of data storage. The rent is ridiculous. The land cost is ridiculous. GDC said, look, we're going to be global. They've got some stuff in France. They've got some stuff in South America. They've got some stuff in Guam. These are the kind of things where they can get a better return on their capital. They've got some in Perth. This one's a small one. It is lightly traded, but we've really got this thing going well and going at a decent, I guess, price target going forward. And I think this one is a warehouse of the future. And I think GDC would be a good buy to hold for next year.
Okay, mate. Some interesting stocks. Thanks for joining us. Talk to you in a couple of weeks' time.
You're welcome. Thank you. Have a great day.
Well, I'm joined by Mike Gable of Fairmont Equities, and I want to ask about a number of good quality companies that recently have been beaten up by the market to an extent, to see whether there's any signs that there could be a turnaround in the wind. Mike, thanks for joining us.
Thanks, Peter.
The first two stocks in particular are ones that fit that bill, Mike. BHP is a company that has done really well. It's come off the boil. And it seems to be going up and down around a certain level, but what are you seeing with your charts?
Yeah, I think the BHP share price is starting to stabilise. So it does look like there is a low trying to form in BHP. So we obviously had that big drop in August, September, but since then the share price range has started to tighten up. So that's what I'm trying to show on this chart. I've put in a couple of blue lines there to show that tightening up. So I think it's just a matter of time until it's ready to to get moving higher. What you could do is actually have a look at, for our viewers, if they have a look at Fortescue's already gone through this process where it seems to have bottomed out, the range has tightened up, and I think it was about a week or two ago we had a move higher in Fortescue. So Fortescue looks like it's already found a low, and BHP seems to be doing the same thing on the chart.
Okay. Yeah, it's interesting. I was talking to NAB Trade, Gemma Dale, and she was saying that Fortescue is a pretty popular stock whenever it gets sold off. And you make the point that recently they've been piling in on it. Let's go to CBA now. This is very recent. I know it's probably too early for the charts to show anything, but I lived in hope. What are you seeing right now?
Yeah, look, not a great move last week. I mean, I have to admit, we spoke about this one a few weeks ago, and I really liked the way it was trading, and it fell away last week. There is some support at current prices, so I've drawn a line at that low in July, and you'd expect some sort of bounce from here. I think at worst, if it can only bounce for a couple of days and then becomes weak again, there's very big support just under $90, which isn't too far away. So it'd just be interesting to see what it can do from here. If it does find support at current levels, I don't think it's going up in much of a hurry. I think at best, if it finds support here, you might see it just build a bit of a base for several weeks, and then it will be ready to get going again. So yeah, just be interesting to see what it does here over the next few days.
Yeah, my view on CBA and BHP as well, I think they're companies that will benefit from a strong global economic growth year in 2022. And at the moment, I guess it's all talk. We have to actually see the results. There's question marks over vaccinations and lockdowns in Europe. So it makes sense that BHP, is taking time to take off. In the case of CBA, it's more the local readings, but what's going to pull them out of these local readings would be a much stronger Aussie economy in 2022. And that's why I think that looking at a company like these around these levels, or maybe at the next bottom one, would be a pretty easy play to commit to if you're prepared to be a patient investor. Yeah,
I agree. And the point with CBA, I still have CBA as my preferred bank. I think it's the best bank. Yes, it's more expensive than the others, and we've seen the short-term effects of that over the last few days. But if our viewers all pull up a chart of each of the banks going back the last several years, the last major top in the banks was in 2015. CBA is above that level. And I think a lot of people will be surprised that the other three banks are still well below those peaks from 2015. So longer term, I think you're better off with CBA.
Okay, let's go to our next one now. And this is TYRO. Now, I've noticed that TYRO has been very volatile. I've also noticed that there's a bit of sentiment against it now. I'm not sure whether it's related to specifics about the company, or and it did report that what wasn't well received from the market, but it's in that payment space as well. Or payments companies have copped it in recent times, and that's why I'm intrigued to see what the charts are telling you.
Obviously, the last few weeks not great for TYRO. I mean, if we go back a month ago, it was sort of knocking on the door of that level around 440, which we could see on a few occasions now is where it has found a lot of selling. So I think eventually, if it gets through 440, that would be a massive buy signal. But in the meantime, it looks like it's still in the wilderness for the time being. It's heading back from those higher levels. In some ways, it's been fairly range bound for the last 12 months. So, potentially if it gets towards the bottom of this current range, maybe if it dips under $3 and finds some support, that might be an opportunity. But yeah, definitely at the moment, there's some negative momentum there.
Yeah, I think a lot of the payment companies are really on the outer. Do you think there's a link between the payment companies and tech stocks, even though they're not necessarily tech stocks in their, they all have technical sort of software and whatever, but do you think there is a bit of a sort of a market association between the likes of Zip and TYRO? I suppose for a special now, but what do you think?
Yeah, I think some investors do get a bit confused that there can be quite a bit of difference between a lot of these companies. On the one hand, you've got businesses which can scale up very quickly. A lot of their sales are online, or in the cloud. And then you have a business like TYRO, which there's a bit more sort of tangible stuff to it. It's they've got to get the terminals out there. They're very much linked to the reopening of the economy as well. So it's a bit unfair to treat them on the same plane as some of the other high PE tech stocks.
Yeah, like the WiseTechs or Altiums or whatever. Yeah, it's interesting also. It's kind of like a cross between retail and finance, isn't it? When you think about it, it's right. And you're right. It probably the next real positive move for TYRO is going to be when we have our total economy reopening. Because remember, we're still not getting into Queensland or WA, are we? And it's good. And fast growth of the local economy should be good for a company like this. But yeah, good point.
Yeah.
Let's go to the next one now, mate. And this is here, Zip. What's the charts telling you about Zip?
Yeah, still no turnaround yet on this one. So the pace of the slowdown in the last few months or so has slowed down. But it is still falling. I mean, there's not really too much to add. I mean, we can see that at the end of last year, it bottomed out around $5. So I think, like a moth to a flame, I think it'll be drawn towards that $5 level in the short term. And then, if you get a bounce off there, that might be a bit of an opportunity. But at the moment, yeah, just a little bit too early to be getting back into this one.
I guess the highest hope for Zip investors would be that it sees a repeat of what happened at the beginning of 2021. That was a nice rise, but certainly haven't seen anything like that for a long time. Let's go to the next one now, Mike.
Yeah, this isn't it's not a very good looking chart, Lease. I mean, as we could see, it got absolutely hammered during that drop with COVID last year. And although it did bounce pretty strongly off those lows, while the broader markets continued to kick on over the last 12 months, this one's just, as we could see, it's just downtrending. So I guess similarly to Zip, there is a low from last year that it's getting close to. So those levels just under $10, it might draw in some buyers. But again, at the moment, I just think it's too early. I just see a stock in a downtrend. So I think it's best to avoid for the moment.
Yeah. And it is a company that clearly still has question marks over the office blocks it owns. It also has a number of strategies around, linking, retail precincts to residential, but it's all out there at the moment. No one, particularly the short-term players, probably see this as a slow burn. At the moment, there's not much of a fire happening under the company.
Look, obviously, other sectors seem to be benefiting, or other stocks seem to be benefiting from everything that's happening out there with the reopening and and the retail spending, construction spending. It just doesn't seem to be flowing through to Lease.
Okay, let's go to a company that actually is in a hot sector. That's namely Lynas. And I'm not an expert on charts like you, Mike, but this is looking pretty positive.
Yeah, exactly. Bottom left, the top right. I've mentioned Lynas a couple of times during the year, Peter. I think as recently as October, it was my pick. I think this still looks great. It's trending. most recently there was some resistance just under $8, and a couple of weeks ago it popped above that. So yeah, it should just be drawn towards the next major level, which is around $10. I've even had a couple of clients buy it as recently as today. I'm still happy to buy Lynas. I think it looks really good.
Yeah, and I guess, as you can see, there are pullbacks, but those pullbacks are really controlled, aren't they? And it says something about the future of this product in the sort of the modern technology products of tomorrow.
Yeah, exactly. I mean, there was a bit of a deep pullback during September, but we have to remember, the whole market looked a bit iffy back then. But since early October, as you say, Peter, any pullbacks have been fairly measured, fairly small. The buying comes in, and the stock just keeps grinding higher. So yeah, I think it looks really good.
Okay, let's go to the next one now. This is your selection.
Yep. So look, another resource stock. So Mineral Resources. It's an almost $8 billion company, so quite a large business. Iron ore production. They've got the lithium side as well. So this is one that I've been picking up over the last week. We've traded in and out of this one before, as we could see. It's fallen quite a way since those peaks in July. So we're talking sort of $65 all the way down towards 40. So I think for this one to recover from, let's call it $42, even back towards 60, I mean, that's quite some significant upside here for investors. So I've been watching it pull back, and what I've noticed is it, found there was a bit of support around $40 and also around $38. And just seeing it sort of bounce off those levels and get back above $40 recently, and breaking that downtrend, it all looks pretty positive to me. And as I said, look, based on, even here, there's still some decent upside. So again, this is another one of those stocks, even as recently as this morning, I've been buying more of it. So yeah, I think there's some good upside here.
The interesting thing about Mineral Resources is that, okay, it's got the iron ore, which clearly has been affected by China's slowdown and the stockpiling and all those sorts of things that get thrown in. But also, the point is in lithium as well, which is an area that everyone wants to be in. So it's diversified, isn't it?
Yeah, exactly. And we can attribute a lot of that recent decline to the falling iron ore price. But I'm still of the opinion that, the iron ore price is thereabouts at its lows, and it will recover, whether it's in the next few weeks or it needs a few more months once we get past the Beijing Olympics. I think the iron ore price will head higher, so you'll have that increasing iron ore price, and obviously the interest in lithium to really get the share price of MIN heading higher.
Yeah, great stuff. Mike, thanks for joining us.
Thanks, Peter.
Well, joining me now is Gemma Dale of NabTrade. Great to see you, Gemma.
Great to see you too.
I won't ask you title. The last time I did was so long, so complicated. But the most important reason why we want to talk to you, apart from the fact that we like you, is that you actually look at what people are trading, what's really hot, what's not. And let's kick off with the stock that is the most traded stock on NabTrade right now.
So last week, it was very predictable if you were watching the market. If you weren't watching the market, you might not have been aware, but CBA had their quarterly update. And even though it looked really great at a headline level, it was very, very disappointing when you looked a little bit more closely. Price was off 8% on the day and another 2% later. So it was off about 10% for the week. And our guys just love that. That's an opportunity that they can't pass up. A lot of our investors feel like they've missed CBA. It's run much harder than the other banks, and by an enormous margin, let's be clear. And for those who weren't holding it, a lot of people have been unwilling to chase it, particularly over the last 12 months. So it hasn't been in our numbers. When it's off 10%, the volumes in CBA, 95% plus buying, absolutely enormous. People were all over it.
So it seems to me then, and we've talked about this before, how when good quality companies get smashed, the NAB trade people are a bit like Warren Buffett acolytes, buy when everyone's getting really fearful.
They're very aware of buying the dip, and they're very astute about holding out for their favoured stocks at a discount. It's worth noting CBA was at $75 12 months ago, so it's not cheap right now above $90. It's nobody's definition of cheap, and it still trades at a significant premium to the other banks. Most analysts feel that that's valid because they've got an incredibly strong business model. Some of the other banks have some challenges that are very apparent. Westpac got absolutely hammered after their annual results. And we saw a lot of buying in Westpac at that point. A lot of people feel that it will come back eventually. CBA is a different proposition. But for those who feel they'd missed out, they'd rather buy it at $95 or $92 than at $106.
Yeah, exactly right. Okay, that's CBA. Any other local stocks that have been getting a lot of attention?
Being really popular. Look, it's still all about Fortescue. It's incredibly popular, and BHP's in there as well. Fortescue's been a really interesting trade this year because the iron ore price just absolutely skyrocketed and then has fallen back to earth, even though it's well above its long run average. So its long run average is about $60 a ton. It's still sort of $80, $90 a ton. So well above that kind of pricing, but it was at 220 earlier this year, which was just extraordinary. Everyone knew it was unusual, extremely unusual. But what it did was allow people to trade very actively a high quality company. And I really enjoyed that because you can watch what happens in the iron ore price overnight and predict very clearly what's going to happen to Fortescue with a fairly high degree of confidence. So that was a hugely popular stock this year and still frequently in the numbers. People really like it. BHP is really strongly in the numbers too. So it was sort of not there for a while. It's back in. The banks are back in much more so than they have been for a while. Where we're seeing trimming, Telstra hits $4 and it just gets absolutely sold off across the board. Everyone has an alert at $4 and wants to trim it down. So Telstra has been sold off at $4. The average sell price was $4.02 during the week. CSL's getting sold over at $3.10. So a lot of people picked it up around the $2.50 mark last year. And earlier this year, it hasn't been a strong performer post-COVID because it's never made it back to its highs, unlike many, many other stocks. So CSL gets trimmed above 310. So we're seeing a bit of trimming in stuff that's performing quite well at the moment and picking up anything that gets hurt.
Okay. What about local tech or payments stocks? Have any of them either been in favour or out of favour in recent times?
There hasn't been a strong theme there. Buy Now, Pay Later was all the rage last year. So Afterpay, it's the stock that everybody talks about. Obviously, they've got that deal going with Square. Once that deal was finalised, we saw very aggressive selling. That's really interesting to me. So there was the announcement, then there was the ACCC approval, for want of a better word. They just said they weren't going to look at it. Once it seemed clear that was going to go through, our guys got rid of it. It's really apparent people don't want to be holding a Square depository receipt in Australia. They're not interested in the aggregated entity when it comes to market. They just want to get rid of those shares. They've done extremely well out of them. And then when we look at the others, Zip was hugely popular last year. It's not really in the numbers much at the moment. There just doesn't seem to be a strong appetite for those sorts of things. If Xero gets beaten up a bit, we see it. It's quite popular, but otherwise it's pretty quiet in that front at the moment.
Okay, so what about your foreign play? I've always been interested that there are a lot of Aussies happy to play with Elon Musk. What's happening in the Tesla story?
Yeah, so Tesla, this is actually an incredibly interesting story. So when I give updates about what people are buying, and you always talk about international, it's actually a really meaningful part of what people trade and invest in now. When it first started, it was a bit sexy, but at the margin, there wasn't a lot of activity there. Now it's sort of between 10 and 20% of total volume all the time. People are consistently looking to take their portfolios offshore, not just through ETFs and managed funds, but also looking at buying the direct holdings. And Tesla is number one. It was Apple for the first few years. Then it's been Tesla really for the last 2 to 3 years, very consistently. It's been an absolute roller coaster ride. Everything's happened with it. They've had a stock split. They got included in the S&P 500 index in the top 10 stocks, finally became profitable. A lot of things have happened with it. It is incredibly popular. It is now just outside our top 10 holdings overall.
Okay.
Which when you think about it, you go, that pushes out Rio, it pushes out Woodside, it pushes out these enormous Australian companies that have been around forever and are in the comfort zone for a lot of Australian investors. Tesla is now pushing those behind it because there's so much passion for that company and that stock. What we also find that I just love, and I think it's really interesting, is when our investors want to invest in green, renewable, impact investing type stocks, anything with an ESG theme, they go offshore to do it. It's not an Australian theme. It's harder to do on the ASX. In our top 10 stocks, we've got 3 electric vehicle manufacturers. We've got Plug Power, which is green hydrogen, for want of a better term. We've got Enphase Energy, which is a very highly regarded solar company. They make microinverters for solar panels. You probably have them on your roof. I have them on my roof. So they're actually widely used in Australia, even though people might not make a connection to the company. This is the sort of stuff they're buying offshore. It's not what they can get in Australia, but when they go offshore, they're looking for COP26 decarbonisation themes that they're not able to get access to here.
Yeah. I think it was around March of this year where I wrote a story about when Tesla's share price fell for your website. I think, I believe you said, this is a pretty courageous story, but I'm looking like a genius now, but I've got to say, I was scared when I was writing it.
It's a roller coaster, right? Tesla is a roller coaster, and it is the most expensive car company. It's not the most expensive full stop, I don't think, anymore, because we've had Rivian come to market and they are brand new and now bigger than Volkswagen. So people are putting a lot of faith in these companies that they are the future, and they're paying for that. They're paying a very significant premium. But people want to be part of the future, and they don't think that buying internal combustion engines is going to be the way to go anymore.
That's right. You can play Bitcoin through Tesla as well, because they've got a pretty big holding. All right.
You can play solar through them if you want. You can do a lot of things.
Okay, so that's it. Is there a Bitcoin play on NavTrade that your investors are using?
There is a new ETF that is a crypto leaders ETF. A lot of small buys in that. It's a really specific demographic who are keen. You need to really look underneath these things and work out what they're investing in, because it's not explicitly Bitcoin per se. So there's no, to the best of my knowledge, approved ETF that allows you access to the underlying asset. They'll give you spot pricing and all of these other things, but you need to be quite careful to understand what it is that you're buying and whether or not that's something you want to hold in your portfolio. But we're seeing some appetite for it. People are pretty keen.
Yeah, okay. And Gemma, before we go, it's a really important day for NavTrade tomorrow. Why don't you tell us about that?
Yeah, it's an incredibly special day for us. It's our annual charity trading day. You guys have been incredibly supportive, and we appreciate that so much. It's really wonderful. It's a day that we did give 100% of our brokerage to charity. So every dollar that our investors and our traders place with us on the day, the brokerage they pay goes straight to charity on the day. And last year, Ross McEwen, who's our CEO, actually doubled, he matched the contribution that our investors have made, which was amazing. So it's a really special day. In the past, we've supported a whole variety of domestic charities. We've supported Rural Aid's Youth Mental Health Initiative, Burrumbuttock Hay Runners, giving hay to drought-stricken farmers, the Luke Batty Foundation, which was really close to a lot of us. So a lot of really important, valuable charities. But this year is really different, right? It's been such an extraordinary year, and so many have suffered so much. So we're partnering with UNICEF this year to look globally and using their Give the World a Shot campaign, which is where they will be giving vaccines for COVID-19 or against COVID-19 to people who'd otherwise not be able to get them. They can't just walk into their local medical centre. And UNICEF has extraordinary infrastructure. They vaccinate half of the world's underprivileged children. They're the biggest vaccine buyer in the world. They are using that infrastructure to provide vaccines for adults now in many of those communities. It's a real privilege to be part of it. So 80% of our brokerage will go to UNICEF tomorrow for that campaign specifically. The other 20% will go to the ASX Refinitiv Foundation. They support 10 different underlying charities. And it is an industry event now, but we're still the only broker that a retail investor can participate through. So if you happen to be wishing to make some trades tomorrow, if you happen to be thinking about trading, we would love you to do it through NavTrade, and you can give the world a shot.
I guess in many ways you'd hope that the market really gets smashed tomorrow, so I don't.
We want some dramatic things to happen
Maybe a
tomorrow.
small
Really
sell-off.
important things. Yeah, big sell-off overnight in the US, something like that would be awesome.
Yeah, I go for a small sell-off. I can live with that because I'll be a buyer definitely for small sell-off.
So are all
Gemma
of our
Dale
guys,
from
right?
Nab Trade. Thanks for joining us.
Fantastic. Thank you so much.
And that was Gemma Dale of NAB Trade. And before we go, let me remind you, on November 30, we have the virtual Switzer Income Conference for 2021. This is all the kinds of investments that you can, in a sense, make income out of, as opposed to just purely going for capital gain. Some of them will be capital gain and income, others will be a pure income play. So if you're looking for that kind of thing, register in the link in the description below. And I look forward to seeing you or talking to you when that conference is on November 30. Once again, thanks for joining us on the program, and I'll talk to you on Thursday night.